Okay, selection number 2 for chapter 21, talking about the statement of cash flows. Page 1210, the primary elements of the statement of cash flows. Remember, we already talked about operating activities, investing activities, financing activities, but also we're reconciling, I mentioned earlier, we're reconciling the increase or decrease in cash with the change in balance of the cash account and any non-investing and financing activities. All right, so the relationships, and I kind of mentioned this in the prior video too. The income statement will pull anything that is sales and service revenue or investment revenue from. Our cash flows will be called cash received from customers though. And we're only worried about cash, so not receivables. Not all sales are going to be cash. Cash revenue received like dividends or interest. And there's the expenses. It's our cost of goods sold. Salaries expense, non-cash, interest expense, operating expense, and income tax. Cash outflows is our cash paid to suppliers, our cash paid to our employees, our cash paid to creditors, and our cash paid to insurance companies and others, and cash paid to the government. And we come down to our net cash flows from operating activities. So then you can see on illustration 21.5 what that might look like. Now, this information is taken from illustration 21.9 in the book. So if you want to see like where did the $98 come from and where those things come from, you have to flip to page 1219, because illustration 21-9 is where the financial statements where you can gather this information from actually comes from. So we have our cash inflows, and this is the direct method, by the way. Cash from customers, cash from investment revenue, and then our cash outflows. The indirect method, which is on the next page for the same set of financial statements, is a little different. The indirect method, we start with our net income and then work backwards to convert to a cash basis. So you'll see that one at the top of it comes with net income, and then we go plus and minus for things that are on our income statement specifically that are either non-cash or should not be included in the cash, in the operating activities, or not included at all because they're not cash. Easiest example of that is depreciation expense. So my net income obviously would have had depreciation expense already taken out of it, because that is not a cash expense. I add that back in. Same thing with something like a loss on a sale of equipment. That's not a cash loss, that's just a loss in and of itself. Increase in accounts receivable is a decrease in cash. Why? Because that means that if my accounts receivable goes up, that means I made more sales, but I did not receive as much cash as what I had in sales. So it's a reduction in overall cash flows. The only part of the statement of cash flows that changes with direct versus indirect is the operating section. Operating activities, cash flow from investing activities and cash flow from financing activities are the same either way. So cash flow from investing activities, remember that's our PP&E, property, plant, and equipment. As you can see there, things like purchases of land would be cash outflows. If we sold land and received cash for it, that would be cash inflow. Sale of equipment, in buying or selling investments, short-term investments specifically. And then we have our cash flows from financing activities, where we report basically the equity section of our balance sheet. So any common shares that in this case, we sold some common shares, that would be cash inflow. If we retired any bonds, that would be cash outflow. And if we paid any cash dividends, that would be a cash outflow. So again, a negative number. Okay, so if you turn to page 21-9, you can see the comparative, sorry, page 1217, illustration 21.9. You can see the comparative financial statements where all this information was gathered. So, and notice too that we have our balance sheet, we have our income statement, and we also have just some additional notes at the bottoms, and those are just all elements you need to have in order to build your full statement of cash flows. So, for example, first thing, we're reconciling our cash, which is a $9 million difference, so we're trying to find that. You see our accounts receivable, 2018 it was 32 million, and 2017 it was 30 million. So what that means is that it went up, which means that my sales revenue, well, I have sales revenue of 100 million, in this case, I only received 98 million. Okay, so where I'm getting that number is I'm looking at the income statement. I see sales revenue is 100. Okay, and I see my accounts receivable went from 30 to 32. So if I sold 100 million, but I have more accounts receivable, what really happened here was I would have gotten all my 30 million probably, depending if I had bad debt or not, but all my 30 million from 2017, that balance that was remaining. And then I sold 100 million, and then I didn't receive 32 million of that. So the net difference is $98 million in cash, which is where that first, on the direct method, where that first cash inflow from customer comes from. That's where the 98 comes from. Okay, so that will be all for that section of chapter 21. The next thing I'm going to do, rather than lecturing on the next two sections, what they do is they go through the building process of the statement of cash flows with the direct method, and then they talk about, I believe next they talk about the indirect method. Rather than lecturing on those parts of the chapter, I think it's better to just work some problems. So I'm going to, the next videos will just be problems and Excel spreadsheets with building the statement of cash flows.